was a relatively quiet night on world markets overnight. In Europe, equity markets were slightly down, and this results from continuing nervousness about the impasse around Greek debt. In the US, however, the Dow spiked up nearly 50 points. This is because the Federal Reserve has announced that it's going to keep interest rates at exceptionally low levels until at least 2014 to try and spur growth. A bit closer to home, the NZX 50 was up around 12 points, but the ASX 200, which had been travelling sideways for a number of days, spiked up nearly 50 points. Looking at currencies, the Kiwi continued to increase against the US dollar, up to nearly 81.5 US cents. It was also up against the British pound, on information that the estimates for fourth quarter GDP in the UK were very weak. The Kiwi, however, fell against the US, falling through the 77 cent barrier, and was also trading in a relatively narrow band against the euro. The resurgence in wool prices last year brought a warm glow to the hearts of many of New Zealand's sheep farmers. At its height, in around about March 2011, the indicator prices for both coarse and fine crossbred broke comfortably through the $6 barrier. Although fleece only accounts for around about 16% of the export value of a sheep, that still was a reasonable amount of icing on the cake for our farmers in view of what had been a relatively good year in the meat markets. However, since November, things haven't been going so well, with those indicator rates dropping by more than $1. Why is this happening? Well, the primary reason is the rampant New Zealand dollar, which continues to make wool relatively more expensive compared to other forms of fibre, particularly synthetics. The Chinese in particular are very price sensitive, and that's leading to a significant softness of demand in Asia. The ongoing European debt crisis is also contributing to softness of demand in Europe. So where to from here? Well, a lot of it depends on what the New Zealand dollar does against its major trading partners. The other possible ray of sunshine on the horizon relates to oil. Oil contributes to the manufacture of a number of the synthetic fibres which wool competes against. An increase in the oil price will make those fibres more expensive relative to wool, and hopefully will drive consumers back to that product.